Hello everyone, welcome to Fearfully Greedy. In today's episode, I will share with you my favorite metrics and a bit of my framework around screening. Screening is a great source to get new investing ideas, but for sure it isn't the only one. In future episodes, I will share you other ways to get great new ideas. If you are new to the channel, I cover investing topics like this one, but I also share a public portfolio that, as you can see now, is sitting at 20,200 euros. And since I haven't done any trades this week, I won't do a portfolio update in this video. But if you're interested, make sure to like and also subscribe to the channel to stay tuned. Let's get into today's video of how to find great stocks through screening. Full disclaimer, as always, these and all my videos are not to be considered financial advice. Please consult a professional or do your own research before investing. The way I like to screen is through three buckets. The first one would be financial health and management. Here I like to use ratios like current or debt to equity. If possible, treasury adjusted, right? And in general, I just want to see if the company is too leveraged, right? It's hard to find a screener that also filters for net debt to EBITDA, but it's a metric that I also like a lot. If not, what I like to do is, in further research of the company, I like to search for this metric for the company because I want to see if the company can pay its debt very quickly, right? The second bucket is for quality. A good proxy for quality would be return on equity, return on capital employed, or return on invested capital, as well as net margin, right? So those are four metrics that I think are very good for quality. Another metric is that I like business that are not with shrinking revenues, or that at least keep a very constant revenue over the years. So earnings growth over 3 or 5 years, and that is over 0, is a good metric that I like to use also. The third bucket would be valuation or cheapness. For this one, I like enterprise value over operating income, or price to free cash flow, for example. Those are good metrics. If possible, the operating income and the free cash flow should be an average over the last few years, because, as I said, constancy is very important. This would be my screening framework. Actually, what I want to fear on you is that the best filter doesn't exist, nor isn't one that covers all these parameters at once. Great companies rank higher on some parameters and lower on others. So these are great proxies for each bucket, but running multiple filters or running them at different times or seeing what companies rank higher on one or another is a great source of good investing ideas, right? For all this, it's very important that we check for stability of these figures, because in a lot of cases, these companies appear on these filters because they had a great earnings years, but those earnings are not recurrent or they are very unstable, and that's why their valuation is so depressed. If we can figure it through their earnings, or at least minimum normalized earnings, it's like throwing a dart on the dark from memory. It's very complicated. If we cannot predict it, we cannot value, and I would advise very against those companies. And this is the work we will have to do after filtering. Now I will show you 4 different websites for screening and try to run some of these metrics through them. Okay, so we're at investing.com. Let's see which of the ratios they have. Let's see, free cash flow, let's say 15 times. I said some of these metrics we won't be able to filter. EPS, okay, 5 year, we want a company that each time grows a bit, or EPS over 5 years. What else we can see? Okay, for here we're good. Volume, price, I don't care. Fundamental. Gross margin, let's see if we have net profit margin. Net profit margin over 20%. Okay, those are high quality companies. Current ratio over 1. And we're at 2 companies already. So maybe we might be willing to pay a bit more, right? Maybe, well, I think this is good. Okay, so for United States, because it's only in the United States, we find these 5 companies. What you want to see is if you understand any of them, right? And then do further research on all of them. If you don't understand it, take it as if it didn't show on the screener. Okay, you can also on investing.com go to other countries. Okay, let's go maybe to Japan, for example. We have 98 on Japan with the same filters. So some markets might be cheaper, so that's a good thing. Like, try to see a bit more of all of these companies and see which one you can understand, which one you find cheaper at the end, because filtering is just idea sourcing, not end of the all of the analysis. Now, stock row, let's do something similar, right? So here we can filter for market cap even. Let's skip that. So current ratio over 1. Okay, so let's do return on invested capital. So over 20. Let's do ROE, return on equity, over 20. Let's do EPS growth. Well, 1 second. EPS growth, but I would like some longer term, like 1 year. We don't get much with that. Revenue growth. Okay, revenue growth over 5 years. I think that's good. Over 0. And then some filter. Enterprise value by EBITDA. What do you think? That's pretty good. Under 15. Well, what will filter is this the lowest, right? So, but let's say under 15 times, right? And then I think that's good enough. Okay, let's see what we get. We got 63 names. We want to see which one is the cheapest in enterprise value to EBITDA. And what we want to see is which are the ones we understand, right? Here at least we have industry, so credit services, that's related to banks. If you are not very familiar with financial companies, maybe skip that one. Software, very competitive. See if the revenues are constant. Spark energy, so utilities. There I might find something like big lots. Big lots comes in a lot of filters, so big lots might be cheap at the moment. So I said no financial advice, but you should be able to go down this list and see which ones you can understand and do a lot of further research. That would be my advice. Let's go to Finbiz. Let's go to the screener. Okay, so in this one, same thing. Let's go to, let's see. Okay, so let's do price to free cash flow under 15. Okay, we are already at 984, right? Let's do current ratio, if I can find it. Current ratio on over 1. Over 1. Okay, let's do, we're at 605. Let's do return on equity, if we can find a return on equity. Over 20. Return on investment, right? Over 20. We're at 44 stocks, right? Maybe now revenue growth, that would be very good. If I can find it. Next 5 years, past 5 years, okay. So over 0, positive. Okay, 42 stocks. Okay, I think that's good enough, right? We could filter much higher, but I think this is a good place to start, because with these 42 stocks, what you can do is start seeing what you like, okay? So this would be for Finbiz. If you see Finbiz has a lot of filters, right? So if you like any of the other ones, like high gross margin or anything, you can go over, and net profit margin, like let's say over 20%. So we're at 15 stocks, right? See which ones we can kind of understand and which ones we kind of like, right? Another filtering tool or screening is Wallmine. I think this is also very cool. What we can do is current ratio, over 1. Then what else? Return on capital employed over 15. Return on equity over 20. I would do this even higher, but let's see how many we end up. Revenue growth over 3 years, positive. And then EV to EBITDA under okay, 200 companies, but what we'll do is filter for them for the lowest one. Okay, again, there are many more screeners, but these are the 4 that I don't know, that I picked, but there are many more. And in them, you can put your filters, what you like to see in a company, filter for those and see which companies rank higher. And it's a great sourcing, idea sourcing. But again, the most work should be done after this. So on research, seeing if we really understand the company, okay? Well, everyone, be safe. See you in the next video. Not sure what it will be about, but for sure on investing. And well, everyone, be safe. Take care. See you.